Let's get the opening bell here.
What's going on, everyone? I just want to briefly walk you through two basic strategies on how you can win in this market. Obviously, if you haven't been living under a rock, you see the stock market is taking a huge hit, going into bearish territory. And, we're going to go over what does a bear market mean. But the purpose of this tutorial, the purpose of this video is not to give any advice or any recommendations. This is just to give some free game, some free gems on how you can protect your portfolio in the future. Because obviously, when it comes to us being prepared, it's unfortunate that things have to happen for us to take this into consideration. We did have a bull market for the last couple of years, so this was bound to happen. But I do just want to bring just a little bit of, of attention to the other side of, just going long, just buying, hoping the stock price increases, because what are you going to do in this situation besides panic? And the only reason you are panicking is because you don't have a strategy. I do see a lot of people, saying, hey, your portfolio can be recession proof, but I don't really see them talking about how you can make it recession proof. And I'm not at all saying that what I'm showing you is going to make your portfolio recession proof. This is just simply going to show you two out of many ways where you can make money when stock prices, when the market goes against you, to protect your portfolio. This is also going to serve as a way to reduce your cost basis when you buy stock in the future. That way you can receive an additional credit, and also it'll protect your stock position if the stock price goes against you. Thank you for tuning in. Let's go ahead and get started. So we're just going to start with, like I said, a bear market. Now, a bear market is when prices of securities fall sharply. Typically, they have to fall 20% or more from recent highs. Recently we did have some highs in all three indices. But now right now where we stand is we're actually almost right back to where Trump came into office, right? And this is mostly caused from widespread of pessimism and negative investor sentiment. Okay. Now, of course, with the Corona scare, we do have a lot of corporations. We do have a lot of the big investors, the big institutions. It's uncertainty. So when they're uncertain, there's a lot of selling that's going on. And that's typically one of the main reasons why the market takes a dive in the direction that it's taking, because it's like supply and demand. Right, when there's more supply for demand, of course, prices are going to drop significantly. So, there's no different with the stock market. Now, in regards to the bear market, like I said, the whole purpose of this is how we can make a profit. Right now, your typical investor, anybody that has a basic understanding of stocks, they do understand that if you buy stock, you want the stock price to increase. Now, when you take the other side, right, you are going to short sell. You're going to short the stock. Now, this is going to occur when an investor borrows a security and sells it on the open market. Now, obviously, once you borrow it, you do have to buy it back at a later date, but you want to sell it at the higher price and you want to buy it back later for less money. Okay, so for instance, if I were to borrow stock from you at $10, if it drops to $2, because when you short sell, you want your stock price to decrease. If it drops to $2, I will buy it back later at $2 and I will pocket the difference and my profit will be $8. Now, of course, short sellers, like I said, they do bet on and profit from a drop in the security's price. Now, typically investors and portfolio managers will use this as a hedge against downside risk of a long position in the same security or related one. Okay, so that's going to be, your more advanced portfolio managers, your more advanced traders. They understand how this works when it comes to proper protection. Okay. Now, of course, there are, some downsides to this, and this can be very expensive. Just like buying individual stock, it can be very expensive. Okay. Now, in certain cases, certain brokerage firms, they are going to charge you margin interest and stock loan fees. So it's like, you can compare it to borrowing from your 401k. You do have to pay interest back on that. But I do want to show you a way. Like I said, I'm going to show you two basic strategies where you don't have to borrow any shares from anyone. It's going to be very inexpensive because I'm going to show you a defined risk trade, and I'm going to show you a live one. I'm going to show you a defined risk trade where you cap your losses, but of course you're going to give up some profit to the upside. And then I'm also going to show you where you're only just going to pay the commissions to whatever brokerage account that you have. Of course, with the amazing Tastyworks platform, one of the lowest in the industry, if not the lowest, just $1 per contract. no closing commissions. So you're only going to pay $1 per contract, and you're not going to pay any commissions on the closing end. So I'm just going to show you on this amazing, user-friendly, easy platform how we can take out two strategies where we can mimic with shorting stock without ever owning stock. Okay, now let's get to it. All right. So of course, now the first thing that pops up, you do see the VIX. Now the VIX gives us an indication. I don't want to get too complicated or go off topic here, but the VIX is what a lot of options traders use to gauge where volatility is in the market. And as you can see, back in February, the VIX was trading at 14. So that is a huge expansion of volatility. That's not good for option sellers. It's good for option buyers. Right now, volatility is a little on the high side. And then, it has some potential to continue to increase, to continue to expand, because we don't know what's, going to continue to unfold with this coronavirus, with the Fed, having to deal with certain bailouts in industries like the airline industry specifically. So it's going to be interesting to see, the direction that volatility continues to move in. But I also will say, more so long term, it is really good for option sellers as well, because we want to capture volatility. We want to sell premium when it's higher, and we want to buy it back at a later date. Similar going back to the shortened stock position. You want to buy it, you want to sell it at the higher price, buy it back at the lower price. The same goes for options premium. When you're selling, in the position that I'm going to walk you through, is we're going to sell premium, and we're going to hope that we can buy it back at a later date at a cheaper price. Okay. Now, there were a few positions that a few companies that I was looking at earlier, having some hard time finding a little bit of volume. But I want to say I found something in the Qs. Now the Qs it's an Invesco. It basically mimics more so like the NASDAQ. So what I'm going to do here, now I am going to be playing with fire because it is within about 7 days. Now, typically, if we're doing it the Tasty Trade way, we do want to go 43 days out, or 45 days out to be exact, because that gives you more time when you have less gamma risk. That gives you more time to be right. And of course, if you're managing it the correct way, you would do so, manage or close at 21 days. But I don't think it was the Qs. I completely forgot which one it was. So let me tune back in. The S&P. Let's see. Actually, yeah. So let's do the S&P. Now this is 3 days out. I'm playing with fire here. Like I said, this is not a recommendation. This is not any advice to get in the S&P. But I am going to show you two strategies, like I said, where you can mimic if you're shorting stock, but you actually don't have to borrow the shares. Now, the first strategy that I'm going to show you is if you were to buy a put. Now we're going to do a put spread because we don't want to do a put, because if we just simply bought a put, we are taking a naked position. You'd be surprised, a lot of amateur options traders take naked positions without owning stock. And when you get that margin call, it's not pretty. Now, typically when you are buying a put, you do want the stock price to decrease. Okay. So as you see here, if we were to buy this put at 231, we just need the stock price to stay below that mark, because we want this to decrease. So what we're doing, we're mimicking shorting 100 shares of the S&P, the ETF trust. So that we don't have to borrow shares from anything. All we're doing is simply using an options contract to mimic, to have the right to assign shares to someone else. Excuse me. If we were buying a call, we would have the right to buy. But this one here, we have the right to sell to someone else. Okay, now technically, if we're looking at our deltas, it's equivalent to 35 shares, but one contract does equal 100 shares, and I don't want to get too complicated in that, but this is one way that we can short shares and make money in a down market. But like I said, this is more so if someone were to own 100 shares, own stock. So what is another way that we can protect ourselves if we don't have stock? We can actually put on a spread. Now a spread is you're buying and selling at the same time. So because we're buying, of course, we're going to have to sell. That is going to protect us. That is going to define our risk. We're going to know what we're losing and what we're making going into the trade, and we cannot lose any more than our max loss. So of course that means the stop loss is built into the position, but at the same time, it's going to give us time to be right, because it's not going to execute or close out that position if it goes below a certain level. I do have a video on my YouTube channel where I'm comparing credit spreads versus stop losses, the pros and cons. Definitely check that out when you have some time. So, like I said, this is one way here. If we were to put on a debit put spread, what we're gonna do is buy and sell at the same time, okay? And typically, like I said, this is gonna show that our risk is eliminated to the downside because it is a bearish position, okay? So when we're shorting shares, when we're shorting stock, you have to borrow stock. But what we're putting on a put spread, a debit put spread, we don't have to borrow anything. All we're doing is just simply taking out contracts to mimic us shorting stock in the stock market. No margin costs, no margin interest, no stock loan fees or anything, okay? Now, in this case, the reason I'm not gonna put this position on here is because I don't want to pay a debit. Because for one, I don't want to deal with time decay. When you pay a debit, your premium is gonna lose that amount, and theta right here is negative 1.2. So my premium would lose that amount every day no matter what. Also too, IVR, implied volatility, is on the high side. Like I said, IV is high right now. So I would hope that if we're buying, we would need it to increase, and it probably is going to increase a little bit more because obviously as we have more updates on the coronavirus, volatility has so much potential to continue to increase, while prices have the potential to continue to decrease as well. But I want time on my side. I want to be able to collect the credit, and I want to increase my chances of winning. And when you pay a debit, you do have a lower probability of profit because you need your stock price to move to a certain point just to make your money back, right? Now, this is one way. Like I said, a debit put spread. Just to recap on this, a put spread. Anytime you're buying a put, you want the stock price to decrease, okay? And the next one, which I'm going to show you and walk you through an actual trade, is going to be a call credit spread. Now, with a call credit spread, we are the same thing. We're buying and selling a call at the same time, but we're still going to be shorting. Anytime you, like I said, one thing I love about the Tastyworks platform, you can set your strategies up right there and it'll put everything in place. All you have to do is just adjust your legs. Your legs are your contracts here that you see. Now, in this case, we've increased our probability of profit. Anytime you buy stock or anytime you short stock, you only have one opportunity to win. So in this case here, what we're going to do is increase our probability of profits because it's going to be above 50%. Like I said, if you have to buy stock or if you have to sell or short stock, you only make money in one direction, which is 50-50. So here, we actually increased our chances to 61%. The stock price is trading at 234. I'm going to short it at 239. So as long as the S&P, the SPY, the ETF Trust is not the actual S&P, but as long as it stays below my short strike here, okay, and I do have a little cushion to the downside. I do have a little cushion to the upside because I'm collecting that credit, but I do want it to stay below 239 within the next 3 days. And I'm pretty confident it will. So what I'm going to do is execute this here. Anytime we collect the credit, it's like fishing. You want to collect it higher so you can buy it back at the lower price. And I see it bouncing around here. It hit 41 cents. I'm going to try to get it there and see if we can get filled and whatnot. Now, I didn't get filled right away. It's at 40 cents here. Let's see if we can hit the mid price. Okay, so we actually got filled there. And I was able to get in at 33 cents, okay? So the trade price here is 33 cents. So like I said, all I need is that stock price to stay below my short strike, and I will be golden. IVR is at 65. I'm gonna collect theta. Time decay is gonna be on my side now, all right? So like I said, these are two ways where you can make money in the stock market. When it's taking a hit like this, you can buy a put spread preferably, or you can sell a call spread preferably. I didn't have to borrow any shares. I didn't have to worry about borrowing any stock. My risk is defined, so I don't have to worry about a stop loss order. I don't have to worry about the position closing, and I'm not having the opportunity to bounce back because the stop loss is actually built into my position. Okay, Now, like I said, these are two ways that you can make money in a bear market. Also, with this call spread, this is another way to reduce your cost basis. Like I said, if you're purchasing stock, this is a way to take out insurance, along with the put as well. But this is the most effective way to reduce your cost basis. Anytime you're talking to your financial coach or your financial advisor, ask them how can you reduce your cost basis from certain positions that you enter into. That way you can increase your probability of winning. Okay. Let me know what questions you have. I know you're like, hey, how can I get started? I will have a video, a tutorial soon, walking you through an application process through certain brokerage firms. Okay, because don't let it deter you, don't let it scare you from filling out the application. It's no different than you filling out an application for a checking account. Okay, now brokerage accounts, they do have to take on certain risks, so they do ask for employment information, but that is a rule that the SEC has set. But I want to, just wanted to show you these two ways that you can make money in this down market by either buying a put spread or selling a call spread. And I will definitely keep you posted on this position. Let me know what questions you have. Thank you so much for your support. And if I did leave anything out, if there's anything that you want to know, just comment, ask the questions, and I will definitely follow up with you. Thank you for your time.